Hey folks, it's Rob Flux here from Property Developer Network, coming to you for another Sunday session. Today's Sunday session is all about profits and how much profit is actually enough, and more specifically, the different ways of measuring profit, because when I go out and ask our community, how much profit are you actually seeking, the answers that come back are very varied and very different. Now, before going too far, I just wanted to let you know that we are using a technology called Restream, which pushes this out to multiple different networks. And so if you are wanting to participate in the chat, make sure that you click on the link below, and I'll be able to see your questions and your comment and be able to answer those in a little while. Now, today's session, whilst it is, I guess, big in stature, is actually quite small in content, so it won't be a very big session today. But what we're really going to cover is what is profit, how we're going to measure it, different ways of measuring it, and why everyone gets confused about the different ways of measuring it. So firstly, let's do some very basic definitions. Okay, so there's a terminology called GRV, gross realized value. Now that is the total income for all revenue or all sales of your finished product. So if you are creating 10 blocks of land, or if you're creating 10 townhouses, for example, then it would be the revenue from the sale of all of those 10. So that is gross realized value. Now, it's important to understand that when we're starting to do some of our calculations. The next definition is total development cost, and that is all costs, both hard and soft, through the entire project. Now, hard costs are costs that you have to spend out of your pocket and cash flow as you go all the way through. And soft costs are the costs that tend to incur at the end when you've got, I guess, revenue coming through, and then you've got costs that are borne as a part of that. So, for example, agents' commissions, etc., settlement fees, etc. Those things are soft costs because they happen when the revenue actually is occurring, so that you don't have to cash flow those other than at the end of the project. And of course, your project profit is then just the adding and subtracting of those two. So gross realized value minus your total development cost. So fairly simple in concept, except that when you go and ask somebody, hey, what is the typical profit that you're looking for? I get a fairly unanimous response, but sometimes get very varied interpretations of what the meaning of that is. And the most common response that I get is 20%, but they don't know 20% on what, they don't know the kind of deal that actually goes into that, etc. So now generally when people refer to 20% return, they're generally referring to the fact that it's 20% profit on costs. Okay, so the amount of costs that I actually spend, do I get a 20% return on that? So in order to get that calculation, it's a nice, simple, easy equation. So percentage profit on cost is the project profits divided by the total development cost. Nice, simple, easy concept to actually capture. But there are other ways of actually measuring profits. So another one is percentage profit on GRV, on gross realized value. So that would also be referred to as developer's margin. So that is how much margin that they're actually making on the deal itself. So for example, that would be project profits divided by the gross realized value. So it's I guess, again, a fairly simple definition. There's another definition, which is percentage cash on cash return. So how much cash do I actually put into a deal in order to then generate that profit at the tail end? Now that one can be quite varied, but it's the project profits divided by the cash used in the project. Okay. Now note, it does not consider any borrowings used. So where this starts to get really interesting is when you go to the bank, what they're looking for is one thing, but when you go to an investor, what they're looking for is something completely different. You see, an investor is looking for a return on the funds that they lend you. So if they are contributing equity into the deal, then they are looking on, I guess, a return on that equity, typically in the form of an interest rate as opposed to a percentage of the profit. Okay, whereas the bank is really looking at a percentage of the profit of the deal. Now, banks will generally only lend you money when you can prove the fact that you don't actually need the money in the first place. So we make money by taking risk. They make money by not taking risk. And so they are looking at, I guess, the return of the project, and then they will lend you a percentage of that, I guess, the revenue of that in order for you to actually run the deal, okay? Now, banks typically, if you're looking for a more traditional bank, they're typically looking for that 20% profit on cost type margin. But if you go to commercial lenders, I guess people who specialize in development lending, they will go as low as 15% in the lending side of things from a profit on costs. Now, there are also lenders that will go much, much lower. So they will go down as low as 10 to 12%, but they get very, very stringent on their terms. They get very challenging with regards to their, I guess, criteria, and quite onerous with the amount of equity that actually comes in. Now, I give you all of these definitions, but they don't really make a heck of a lot of sense when you're comparing projects, because when we're talking about a 20% profit on cost type project, we're typically talking about a project that takes multiple years. But how does that actually compare to a project that might only take 3 months, 6 months, 12 months, for example? And so what I prefer to do, rather than just go, what is the project return, what I prefer to do is actually try to annualize it, so you can actually compare a small project with a very big project and see how hard your money is actually working. So actually annualizing the deal. So for example, that a townhouse project that might take 2 years to run, that gets a 20% profit on cost, when you actually annualize that, that's about a 10% annualized return. So when somebody says, hey, how much profit are you looking for? And you say 20%, what you're really saying is, well, what I want is 10% annualized. Now, I have done and am happy to promote the fact that I've done deals as low as 7% return, but they have taken only 3 months to run. And when they only take 3 months to run and you then annualize that, that is a multiplier of 4, that it becomes a 28% annualized return. And so I know which one has my money working much, much harder, the one that's getting me 28% return annualized as opposed to the one that's doing 10% return. The difference really between them is how much money actually goes into the deal. So the more money that goes in, then that percentage profit comes back as a percentage of the cash invested. So the more cash you have invested in the deal, the more profit you will actually generate at the tail end of that as a byproduct of that. So when you're doing those smaller duration projects, typically the amount of cash required is much, much lower. And so it seems like the cash return is lower, but how hard your cash was working is very different. So make sure that you actually understand that. Now, when you're talking your profits, though, it really comes down to who are you talking to. So if I'm talking to a bank, what they really want to see is the percentage profit on cost of the deal itself. Okay. Whereas if I'm talking to an investor, they really want to know about the percentage return on their funds. So if they lend you 100K, how much cash are they getting back in return as a percentage of that? You see, I see on many, many forums when people say, hey, what sort of returns are you looking for? People say, look, I want 30%, 40%, 50% return. What they're really talking about is cash on cash return. Okay, so if I put 100K in and I get a 50K profit at the end of the deal, then that is a 50% return on that cash on cash. But it might have been a total development cost with all borrowings and that sort of thing of much, much higher number. So I'm going to go through a scenario in a sec that will actually play that out so you can actually see the definition broken down and how that's going to map out. I try and play it out nice and simplistically for everybody to actually understand. But cash on cash return doesn't really take into account any borrowings that you might have with regards to leverage of the debt in the project, any borrowed funds you might pull from a line of credit, all those sorts of things. And so it starts to get really, really tricky. You see, you need liquid cash to run the deal, but if it's not your cash, then for you, it might be an infinite return, but you borrowed cash off somebody else. But so for them, it's a percentage return on what they loaned you. So it can be quite tricky in order to actually map that out. Now, as I said, today is going to be a relatively short process. What I'm going to do is I'm going to give you a hypothetical project to try and work through. So here is an example of a project, okay, very simple theoretical project. Now, this simple theoretical project has a purchase price of $1 million, a deposit of $200,000, borrowings of $800K, the project running cost is $100,000, and the GRV, or the gross realized value on sales, is $1.2 million, with a project duration of approximately 6 months. So given that, if we do this, we've got a purchase cost of $1 million, we've got project running costs of $100K, we've got a revenue of 1.2, and so it becomes really, really simple. So project cost, purchase price $1 million, 100K in borrowings, revenue of 1.2. So our profit is very, very clearly $100,000. Okay, nice, simple, easy to see where the profit is. Okay, now let's start to do the equations on is it percentage profit on cost. Okay, so percentage profit on GRV, I should say. So GRV is 1.2 million. Our profit was 100,000, so it's 100,000 divided by the 1.2 million gives us an 8.3% return. Fairly simple, easy math. Okay, if we look at percentage profit on costs, well, the same 100,000 is now, I guess, divided by the costs. Now, the costs are the 1 million to purchase plus the 100K of running costs, so 1.1. So it's 100K divided by 1.1 million gives us 9.1% return. Slightly different measure of the exact same profit. Now, what about cash on cash return? Well, in this instance, we put $200,000 in for the deposit. We put $100,000 for the project running costs. So we've got a total of $300,000 of cash in the deal. Okay, now in this particular instance, $100,000 profit divided by 300,000 gives us our 3.3% return. So you can see that the same profit measured multiple different ways is going to give you very, very different answers. And so when people say, hey, I got X amount of return on my project, the question really comes down to, well, which profit were you actually measuring and under what timeline? Now, as I said, I like to measure this against time, okay? So, and try to annualize this. So if this is a project that takes 6 months to run, then let's annualize this, okay? So percentage on GRV, we're just going to multiply each of these answers by 2, because 6 months multiplied by 2 gives us 12 months. So percentage GRV would be 16.6%, 18.2%, and 66.6%, okay? Now, the bank is going to care about these numbers up here, okay? And more specifically, this one here, percentage profit on cost, 9.1%. In this particular instance, okay? Now let's imagine, but our investor is going to care about this one, okay? So 33% return, that's what our investor is going to care about. Now let's imagine this exact same project, the exact same parameters, so the same purchase price, the same deposit, the same borrowings, the same profit, the same running costs, except this time there were some delays in the project, or the approvals were going to take a little bit longer, so the duration of the project takes 9 months instead. Now, where this gets interesting, all the profits, all the running costs, all of the, I guess, the purchase scenarios, everything is exactly the same. The only thing that's actually changed is duration. So when we start to measure this profit, exactly the same, okay? Percentage profit on GRV, exactly the same. Percentage profit on costs, exactly the same. Percentage cash on cash return, exactly the same. The only thing that has changed is the annualized return. And when we start to do the math on that, because it's 9 months duration, then when we annualize that, it's 11.1% profit on GRV, a 12.1% profit on cost, and a 44.4% cash on cash return. Now, the bank is still going to be looking at this profit on cost number, the 9.1. They're not going to notice the difference. But you, when you're trying to compare projects to each other, you're going to look at the annualized return. And what you're going to see is for these annualized returns, 44% cash on cash versus 66% cash on cash, you go, well, it's clear which deal is actually the better one to run. So if I had the same deal turn up at, I guess the two deals turn up at the exact same time, and I looked at the timelines in trying to compare my projects, I can see which one my money is working hardest in. And so that's what I'm trying to do. I'm trying to work out how hard is my money actually trying to run. Now, simple, easy equation, but then we just multiply that out based on, I guess, bigger projects. So typically what I personally look for is that if the project duration is less than 12 months, then I'm aiming for a 15% annualized return. Okay, so 15% annualized on my profit on cost. So you can see in this particular instance, whoop, hang on, hit the wrong button. You can see in this particular instance, for the first deal, I would have got my 15% annualized with my 15% profit on costs. But on the second deal, it would have got 12.1% annualized. Now, most people go 15, if I said, hey, I'm only getting a 9.1% return, most people would think I've got rocks in my head. But when I annualize that, it means that that's a fairly nice, easy churn. The risk versus reward is relatively low, etc. Now, the longer the duration of the deal, then the less annualized return I'm actually looking for. So as it goes over the 12-month period, then I slowly, if I'm going out to 18 months, I'm probably looking for about 12% annualized. If it goes out to 2 years, I'm looking for about 10% annualized, just like everybody else. Okay, so no real difference there. Now, what I want to do is go, well, what if I didn't borrow what if I didn't have any of that cash? Where it gets really interesting is if I pulled the deposit out of a line of credit. Okay, so if I pulled it out of a line of credit, it's not technically cash, it's technically a loan. Now, because it's technically a loan, then that deposit figure would no longer be part of the cash on cash return. It would actually be 100K running costs out of my liquid cash with 100K cash in, which means that I got 100% return on my cash. If I had have actually borrowed that through a joint venture money partner or somebody like that, then for me, I had no money in the deal. So my cash on cash return for me with no cash in, my return is infinite. But the person who loaned me the cash, their cash would still be this cash on cash return. So as you can see, it can get, very interesting when you're starting to look at the different ways of measuring deals and the different ways to actually measure the profit. Now, as I said, today's session is going to be a little bit short because there's not much to really cover here, but it is a confusing thing that many people get to. So what I'm going to do is I'm going to see if I can whiz out to Facebook land and see, are there any questions coming through? And at this point, I cannot see any questions, which is really interesting. So let me see if Facebook is talking to me at this point in time, and I cannot see anybody at the moment giving me any questions. So let me see if I can find something. Why, oh why does Facebook play with me like this? Okay, I can see lots of people watching, but I can't actually see any questions coming from anybody. So if you have any questions, folks, now is the time to actually ask the questions so that I can see that coming through. Now, there is a little bit of a lag, and if you haven't, as I touched on before, if you haven't if you haven't followed that link before with Restream, if you don't actually click on that link, then I won't see your questions come through. So make sure that you please do follow that. Then I'll see your questions come through. It'll be nice and easy. So the link is just there. So make sure you do that. Okay, trying to see anyone else coming through. And as I can't see any questions, I will see what I can do to fill the time while I wait for some people to come through. Okay, in the next couple of weeks, guys, at our upcoming meetups, we've got some really interesting presenters in our Sydney meetup. We have a presentation from Crowd property, and crowd property are going to be talking about how you can actually get lending through crowdfunding and how they can facilitate that and the legal process. So whether you're wanting to be an investor with a small amount of funds and invest in somebody's project, or alternatively, if you're a developer looking to have that funded by someone, crowd property is able to facilitate that and become I guess, the glue in between both the investor and the developer, so that your small amount of cash can go towards someone else's deal. In Melbourne coming up, we've got PRP valuers. They're going to be talking about all things valuations, including some new legislation that's coming in Victoria with regards to, I'm trying to think the name of the new tax that's coming in, but it's all about, I guess, a windfall tax that is coming in, and why valuers are super busy at the moment trying to assess a whole bunch of things to try and see where people are actually going to be impacted or potentially avoid their windfall tax. So make sure you come and listen to that, plus learn all the different ways that you can actually work with a valuer to achieve all sorts of things, not just from a standard house valuation, but also from a as constructed valuation and during the development process and what that's going to look like. And then back in Brisbane, we then have, I guess, if you want to go to, if you need to take your project through to, I guess, the High Court to challenge any council restrictions, we're going to be talking about how to take it through to Planning and Environment Court, which in other states would be VCAT or NCAT, etc. So in Queensland, it's called Planning and Environment Court. So if that is of interest in understanding any of those coming through, make sure you keep track of our questions. Okay, I can see a whole bunch of people coming through now, finally. So hi, Rob. Yes, I can see this. How do you annualize the profit? Ben says, how do we annualize the profit on cost? It's really simple, Ben. What you do is you say, firstly, understand what your profit on cost is. So you know what your profit is. You divide that by your total development cost. So that firstly gets you the, I guess, the profit on cost to start with. And then you consider time. So if your project took, let's just say 18 months, then you divide it by 18 to create a percentage as 1 month. Then you multiply it by 12 in order to bring it back to annualized. So equally, if your project took 6 months, then you would divide it by 6 and then multiply it to bring it to 1 month, and then multiply it by 12. So I guess firstly, work out the total number, then work out the duration, divide that by the number of months, and then multiply that by 12 to get back to an annual. Hoping that works. Chasen says, which ratio does private funder look at? So when we say private funder, Chasen, let's do a point of clarification here. So there are private lenders who still work in the commercial space, and then there's I guess your own individual private friends or investors that are, I guess, directly related to you that might be high net worth individuals. So they look at a very different thing. So if it is I guess a more commercial style lender in that private space, they're looking at the profit on costs. If it is, I guess, an investor in your deal, so where you've got someone that's a one-on-one relationship, they're looking at cash on cash returns. So when they put their cash in, how much cash are they getting back in return for that? Juliet says, current market is elevated land purchase prices. What would be a realistic return to expect on, say, 4 or 8 townhouses? Should we be holding out for 20%, 10% annualized, or settle for less? Juliet, that's a hard one, because you've got to look at your, I guess, your total project duration and how are you actually exiting the deal. Where I'm getting a little confused, you're saying elevated land purchase price. So I think you're saying the raw cost of the site is going up. I would still be trying to look for your 20%, I guess, returns on that, given that the project is probably going to take you 2 years if it's a townhouse. That is then going to give you that 10% annualized. So absolutely, you should be aiming for that. Note, however, that we can only make market predictions based on current market prices. Okay, now this is a topic I've talked about many times. So if you haven't heard those, go back and have a look at some previous Sunday sessions. But functionally, we are looking at historical sales in order to determine whether or not we are going to make a profit in today's market. In reality, we're actually selling into a future market, okay? And so rather than looking at price indicators, which look backwards, what we need to look at is market drivers, which look forwards, okay? And market drivers are going to tell us whether or not the market is likely to go up or likely to go down. And that way we can start to factor in, I guess, the potential market shift either up, down, or sideways into the future that we're actually going to be selling into. Now, we should never be relying on the market going up in order to get our profits, okay? Instead, what we're wanting to be doing that is using that to stress test our deal and say, at what point would our deal actually break? What is the likelihood of the fact that the deal is going to break? And would I be willing to bear the consequences of that if the market did go against us? So go and have a look at several of my previous Sunday sessions that talk about that, Juliet. And you'll get some really good insights into that. Chasen says, and what are these benchmarks for different projects? Chasen, as I said, for most projects that are going for 2+ years, you're looking for that 10% annualized. That's the key. That's what most of your banks are actually going to be looking for. So that's going to give you a 20% return on a 2-year deal. Now that's what most banks in the traditional sense are actually looking for. You can get lenders that will go as low as 15%, which is about 7.5% annualized. Now, you want to be really cautious. While you can get the lending, you've got to start to factor in that, hey, that 7.5% interest is not a lot. You could almost get more by sticking your money into good term deposits and that sort of thing. So it's a lot of money to put on the line to make a risk like that. So you want to be very, very careful when you're going for those skinnier deals. That said, if you take on a development approval that's already approved and all you're doing is taking it through to construct and your timeline is very, very short and very, very compressed, then you might find, hey, I can construct all of that and sell that within 12 months. 15% might be okay at that particular point because annualized 15% is actually pretty good. So it's all about the duration of the loan. That's probably the biggest thing I can say, folks. So if it is less than 12 months, I would be aiming for 15% annualized. If it is between 12 and 18 months, I'd be looking for about 12% annualized. And if it is closer to 2 years, or beyond, I'd be looking for 10% annualized. They are the benchmarks that I would actually be looking for. Karen says, I see flux developments in my area. Karen, I see them as well, but they are not me. That's somebody else who has stolen my name. They are doing quite a number of projects, but they are not me, I can assure you. However, I keep track of them. If they ever do anything wrong, let me know, because that's my name that's up at, I guess, potentially being challenged out there. Chasen says non-bank lenders. I think that's in reference to your question before, Chasen. I'm not 100% sure. And what are the benchmarks for different projects? As I said, go for those ones. 10% annualized for the bigger deals and 15% for the smaller deals. That's kind of the best way I can frame that. Juliet says, yes, raw cost of land up right now, thanks. No problem at all, Juliet. As I said, assess market drivers. What is actually pushing the market up right now? And what's the likelihood that you are going to get that uplift? Yogan says, hi, Rob. What is your view on private lending? My view is it's a fantastic tool as a resource to actually use, but just like any other tool in your toolbox, you don't always use the same tool over and over and over. So if you only have a hammer in your toolbox, then everything starts looking like a nail. Instead, what you want is a hammer and a screwdriver and a set of pliers and a shifting spanner and a whole bunch of things like that. So private lending has its place. It is a little bit more flexible on its terms, but at the same time, it's a little bit more expensive in the process. And so you want to understand, well, what is the problem I'm trying to solve? At any one given moment in time, today you might have cash. You might be able to fund the entire deal yourself day one. Then deal number 2 comes along, you no longer have cash. And so then private lending starts to become attractive because that way you can actually keep your projects running then the first project finishes and you got cash again, but the next deal might be twice as big, so you can have a blended approach. So each time it's different. So don't always rely on using it, but know it's a very valuable tool and very, very worthwhile tool. But just know that there are, I guess, private lenders out there that are, I guess, very fair, very scrupulous, very, I guess, giving of nature, and there's others out there that are sharks. So just be very, very cautious of who you're with, etc. Karen says, wow, I'm presuming that's in relation to Flux Developments. Yes. Okay, well, that appears to be all the questions, folks. So thank you very much. As I said, it is a short session today, so appreciate your time. And as there's no more questions coming through, I'm going to say bye for now. Thanks, folks. Bye.